Wayne, what makes the Efficient Market Portfolio Plus ETF, ticker EMPB, unique? There's lots of ETFs out there. Why is yours different from all the other ones?
Well, thank you for having me on the show, and thank you for asking that question. Almost all ETFs either follow an index or they manage risk through diversification. What we do is we employ risk management in our ETF. Why is that important? If you look at the broader market in the first half of this year, it had a 20% dip. It's finally recovered, but it's been incredibly volatile and you've got nothing to show for it. Our maximum drawdown was 7.75%, and we're now trading 4% above our high water mark. Risk management puts you in a position where you recover from a higher level.
And this is an ETF that invests in other ETFs, correct?
Yes.
Why does that reduce risk?
Investing in other ETFs doesn't reduce the risk. The algorithm identifies what we should and shouldn't own. But investing in an ETF offers great advantages to the average investor. This kind of risk management formerly was only available through hedge funds that charge 2 and 20. Our management fee is 1%. As an ETF structure, we're in the position where when we rebalance the portfolio, we do 531 offsets, which is not a taxable event. So your holding period owning an ETF begins when you buy it and ends when you sell it. It has little to do with what goes on in between those 2 points. And then finally, because we have shorts in the portfolio, we earn interest on those shorts. And currently we're earning across the broad portfolio against AUM, we're earning about 2% interest, which offsets our management fee and almost all associated fees.
And where are you seeing the best opportunities in the market right now? Clearly you're hedged, you're long, and you're short. So where do you see yourself making the most money?
The market has 3 tailwinds. It always has 3 tailwinds, and that's why buy, hold, and hope has always been so popular. All right, so the 3 tailwinds are inflation, that's not going away. Increased population, maybe that's stumbling a little bit with the immigration war we're having now, but more importantly, innovation. AI and semiconductor technology is exploding. We adjusted our fund about 6 months ago to incorporate more than that, include that in our fund, weigh it a little bit more heavily. But the other thing that we're doing now is focusing on energy because something's got to power those chips. And so we've included uranium in our portfolio because I don't know how you're going to get all the energy you need to power all the chips that they want to use for AI.
And then can you talk a bit more about how you mitigate risk within the portfolio? Because when some people hear, well, we short some things, that scares them.
I understand that. We only go short on a 50% basis, but let me ask you this question. When the market peaked in 2008, how many years, 1998, how many years did it take for somebody who bought that peak to get back to break even? 13 years. When the market peaked in February, it took all the way to April to bottom out, and now we've just regained that high watermark. And I don't know if we're going to have a double top or not. I don't think you do. I don't think anybody does. So the real trick here is to have a balanced portfolio so that if we do run into one of those tumultuous periods with volatility, a portfolio like this benefits from every revolution as the market bounces up and down. And I think that's the best way to address the risk. And then finally, don't put all your eggs in the basket at one moment because it peaks in a moment. It doesn't peak over a period of 6 months. So lever into that.
And then finally, so where does the EMPB ETF fit in a balanced portfolio?
I think that works on 3 levels because investment advisors don't have one customer. They have many different types of customers. So you've got the small customer just starting out or somebody near retirement that needs extra income. Just buy EMPB and forget about it. They don't need a lot of your time. It should perform well and you can have confidence in that. If you're a type of manager that's more actively involved with your clientele, what you might want to do is use EMPB as your foundation and then surgically and specifically based on your research, identify when to add Bitcoin or metals or real estate or commodities. That's up for you to decide to bring it. And then there are all of these wealth growth considerations that are important to an investment advisor. And then finally, you have investment advisors that really specialize in an on-off strategy. I want the risk now, I don't want it then. Well, before it was risk on or cash. Well, now you have the choice of risk on, a hedge portfolio, or cash. And for example, when the market fell 20% and we fell 7.5%, if you had switched from our ETF to, let's say, the S&P 500, you would now have a 16% year-to-date rate of return where we're sitting at 9%. So if somebody wants to be actively managing where to hold the risk, it might be a good product.
All right. Well, thanks a lot for coming on and talking about it.
Always a pleasure. Thank you very much.